And thank you, Blake. Thank you, team, and welcome back, Peter Cambell. How are you, buddy?
I'm good.
Good. Great to see you, Peter. You going to share the screen? I want to
Yes.
acknowledge something, Peter. You and I were in touch when the market was selling off in September from 5, 6, 7%, and prior to that, you thought it could be a pretty deep one. And right near the lows, you said it's not going to happen. And we had a bounce, and then we had one more marginal low early October. Great call. What was it that first had you bearish at the top, and then how did you know that it was just going to be just another one of these short-term pullbacks, and that was it? And still can't see your screen.
Well, it's coming up right now. 1 second.
Okay. And anyway, great call. See, I remember.
Well, this was a very unusual.
Still not seeing anything, Peter, on the screen.
1 second, we're doing it.
Okay. Here we go.
Got it?
Yep. All right. This
was a very unusual moment in the markets. Normally, they should have gone down and hit the 100s, basically below 4,000 to finish that move.
Yeah.
And we started getting a situation where people were generating more fear and higher lows. So basically more panic.
Okay.
But we weren't able to get follow through to lower lows. And that happened when we retested 4,300. Rather than we should have been able to, if sellers were in control, to break down below 4,250, and we weren't able to do that.
So the sentiment wasn't right. There were too many bears on, many people looking for that.
Sentiment needs to match price. So what I do is very sentiment oriented, and that also means flow oriented as well. But what happens is that if you're making highs, you need the optimism that people have to match the prices. And if people have the right optimism, and this is why people consistently misinterpret sentiment, high sentiment does not mean lower prices. High sentiment, depending on what sentiment, the way you create it and how you build it, high sentiment
could be confirming.
It's confirming. Most of the time, if you get new highs with higher sentiment, optimism, for example, you have conviction there. What we need to see is disagreement, and there's two ways that you can have that disagreement. One is that you can make lower highs with higher optimism, and that's the most negative. I call that bearish excess energy. And then you have a situation where you can make higher lows with more negative sentiment. So you can be more pessimistic, but the lows are higher than previous lows, and that is called bullish excess energy. And basically, it means people are spending in more energy trying to sell a market, and they're getting less for it. And the result of that is almost always that people get trapped. I would have expected normally this market to do a retest of the low, even if it did bounce. So when we bounced over huge X-tick area at 43.99, I would have expected the market to get about 80 points from there, 70 points from there, and then pull back. This rally has been inordinately strong, and I'm going to show you a couple things of what I think is going on here and why.
Yeah, please.
But let's take a look at the transports index. This is a recent transports. And we should talk about it in terms of the impact that's being felt across the world. Essentially, markets are in a huge state of imbalance, and I'm hearing a lot of people feeling like the markets are going to continue to go up, and all these things are, going to be stable as long as the Fed is doing what they're doing. Tapering is,
hardly. It's a dovish taper.
It's still in flow, so it's still going to pump the markets. The problem is the markets operate on rate of change, And the other things that markets operate on is flow. And so what we're seeing right now is a disruption in markets, which is the scariest thing I've ever seen in my life in terms of markets, where options market makers and other kinds of market makers are basically getting taken out in body bags. The situation,
the option, because they're writing calls.
well, because they are responsible for doing the other side of deals that people are involved in a systematized manipulation of markets. So people like Elon Musk created a sort of process to manipulate his Tesla, in my opinion, and that became very popular with SoftBank and a bunch of people who cannot resist doing it.
Do you know how they do it?
Yes, they buy. Well, there's two ways, and this is what I have the transports chart up. So essentially, if you have an outsized positioning of options, so let me give you a quick introduction. In the stock market, if you want to sell short, you can only sell short what you can borrow. So you have to get the shares to borrow, and you have to pay a fee to borrow them. If you're a market maker, you don't have to pay a fee to borrow them, and you can sell as many short as you need. You can sell naked short, and you can sell more than the float of the company short. There's no limitations on it because you have to be able to hedge your put options. And if somebody wants to buy 100 times the float of a company in put options, they can do it. There's no way to tell somebody, oh, we only limit the amount of put options that are available to the availability of the float.
So the specialists have to go out and buy the stock to cover it.
Well, if it's a put option, if it's the call option, they gotta have the delta hedge there. The problem is that if people buy more calls than are actually available in float in that period of time, they are going to create delta hedge influences which push the market higher. And what's happening is that these guys are manipulating the weekly and daily and short-term and out-of-the-money call options so that the market makers cannot hedge the amount of liquidity they need to hedge until the next morning. So if you buy your call options exactly at the close, then they need to wait for the cash market to come in and do the rest of their hedge, and they have to try to do whatever they can in the futures market. But this is creating huge problems. Now, I want you to look at this chart. This is exactly what happened in a major index. So the biggest up candles in the history of this index with options on it. Let's see, where is, I got to find the Goldman chart, sorry. And something happened interesting yesterday, which is that right after we have this huge run up in the transports index, which has tons of index options written off of it. Goldman Sachs was down yesterday, and it was down at the lows of the day when the market was busy going up at the highs of the day for a part of the day. And you have to ask yourself, well, why is that happening? And is it going to get worse? Well, my particular belief about it is that you cannot maintain stable options markets and options market making when you have people like Elon Musk disrupting the market structure to the degree that they are so that they can pump their stocks higher. And then when you create this kind of sentiment where people will go out and buy 5 times the float in call options of the entire Tesla, then what's going to happen? You cannot limit the impact of what this kind of situation creates, and the damage that can be created to the market makers in these situations is catastrophic. So my prediction is that you're going to see an exit from options market making from a lot of very large firms. I believe Goldman is in trouble. So I think that what we're looking at here is that as a result of some of this disruption between Tesla's BS manipulation of that Hertz deal, which was just noise to cover for this, for the options positioning they were doing. So this would have happened without the deal, in my opinion. that was just a cover story to make it look like there was a reason for it. The real reason was that they were manipulating the actual derivatives market to pump the stock. I think this is destabilizing the markets. I think Tesla could go much higher if the options continues to be so influential versus the actual float of shares available. But it will bankrupt the market makers that are on the other sides of those deals for two reasons. One, they can't adequately hedge on the way up, and two, when they have to unwind those hedges, they're unwinding them at losses. So they're basically putting on hedges at losses, and then they're unwinding them at losses.
So as long as the market keeps going up or in parabolic, who cares about market makers losing their jobs and taking financial hits?
Yeah,
I mean, we don't have a lot of open outcry anymore anyway, right? Who cares about those guys?
Yeah, it's and the problem is people don't really realize that when you go to buy an option and you can't do it, or when the prices are through the roof because there's nobody who wants to make the markets.
No spread. You mean the bid offer blows up?
Well, I think we could be in for a period of extremely high premiums in options if things go wrong. And what are we going to do? Have the government start being the options market maker and backstop that market? I don't think so. So, I mean, I wouldn't be surprised with the government trying to do that because they're doing such a good job of ignoring all these problems. I mean, they know what's going on and they're ignoring it. And the problem is this is going to create systemic risk unlike anything ever seen in the history of markets. So while everybody is sanguine talking about how the Fed is, just continuing going on, the problem is rate of change of liquidity affects especially situations like institutional market making, where that liquidity is specifically making possible for these people to survive in this incredibly arduous time for them to make money. And you would think that options market makers are making money hands over fist. I'm telling you, you cannot make money hand over fist in a disoriented and disorganized market like what we're seeing right now, where people are actually, where retail is profiting in such an odd way. So anyway, let's get on to, that's an important structural thing I wanted to share with you.
Okay. It's interesting, Peter.
An interesting thing that's happening is that I just want to point out the sector to people. I think something to keep an eye on, because if you want to know when there's going to be more lockdowns, or you want to understand economic implications that could be coming, SCI is Service Corporation of America. It's a funeral and death services company. I'm not trying to be negative. I'm just bringing it up. Basically, almost all death services companies are at 52-week highs, 20-year highs, 30-year highs. It's a good idea to keep them on your radar. One, to potentially look at on pullbacks. And the second thing is, if we are going to be looking at more government action or more panic from politicians, something it's good to be ahead of.
Are you expecting another lockdown over COVID?
I don't really credit it to COVID, but I would say there's going to be more problems, I think. And what these stocks are telling me is that there's going to be problems. So,
because last time you were on, you were certainly right about a lot of the shelves. A lot of things are disappearing from the shelves that you can't get anymore.
Yeah.
Okay.
But looking at the markets on a short-term basis, this is my historical X-tick chart. Basically, over here, if you see this bright line, the thick line, that was the 4,400, 43.92. I think you can see the little. It started at 43.92, and the X-tick, the emotional price, completed at 4,400. And when we broke out of that, that implied, about 70 to 80 points higher, which we got. But oftentimes those X-tick breakouts become much more. They can become, so we tested 490. When we broke over that, then we were going to take out highs. That was it.
Right.
There was one chance for the market to go down from that 4470, 4480 and retest, and it didn't. But this emotional break is important what it looks like to me is that we have a leading diagonal for 4. I'm sorry that I put the 4 in the wrong area here. I don't like Elliott wave that much, but sometimes I find it useful. But the 4 should be actually at the end of that diagonal. But it looks to me like we have 4,700 test coming here, pull back, and then 4750 to 4780 blow off. I'm going to show you a few things that are going on in terms of we had this big wedge, which we broke down from this contracting diagonal, rising contracting diagonal.
Yeah,
broke
we're
down.
about to tag it. Yeah.
That
Nice.
should have been a much larger drop. We couldn't get to the large moving averages, and we undershot that. So then now we're squeezing back up. This red line right here represents a major non-confirmation in terms of breadth. So we're not seeing, well, I see a lot of people talking about how great breadth is. I'm telling you, it's not. Let's take a look at another measure of
What
breadth.
was your number again, Peter? Excuse me, on where you think 5 will end in the
Well, we're
S&P?
gonna go through it on another chart, which just show it a little
Well,
more clear.
I just need it for, the description of your
47.40 on the low end, 47.90, 80
Okay.
on the high end, I think.
Thank you. Got it.
So
Go ahead.
basically, here we're seeing 2 other measures of breadth, all non-confirming on this whole move. This is very disturbing, in my opinion. This is the chart that I think is an important one. We have the depression over here. We have 1999, 2000 right here. And what do we have here? 2021. So we are now within about, say, 70 points of tagging this channel. Now, I know everybody thinks that this is going to be an overthrow, but I'm going to be very clear with you. I've been in the markets a long time. You do not have channels like this connecting 3 bubbles of epic proportions and get an overthrow. The market will be rejected somewhere between 47.40 and 47.80. And the rejection is going to turn into at least a very large pullback, but very likely, in my opinion, a bear market. I thought we could have I thought we were possibly close enough for government work in September, but we weren't. So then it became clear on this bounce that we were going to have to hit this dead nut. And so I started being extremely accurate to render this channel. This is another very important chart. Essentially, we have, I'm sorry for the noise in here, but I was looking for a major high the last time around, and we did get that pullback, as you can see, off of this throwover. But this is such a wacko market that we're doing a third throwover. And we're also retesting the momentum channel, which is going to come in sometime in the next day or two, I believe, or few days. I think we could be at this 47, 40, 47.20, 4700, 47.50 this week or early next week. And I think that the repercussions from there are not going to be mild. So I don't believe there's a sanguine interpretation for this market. Here's another look at breadth, and basically what we're seeing here is that NYAD is not a great measure. We're seeing disagreement here between NYAD and NYUD, and that was always important to note. So these highs are going to be unsustainable. Here we're seeing a channel in the euro. If you know me for a long time, you know I have been talking about the secular bear market in the euro. I have posted this particular thing in real time. I have discussed it for a long time. I had it there before it ever happened. I suggested the bounce would stop there. well
Yeah, you
before.
did 122. I think you were talking about. I
Yeah,
remember that.
and the euro is going to 0.88. So this is, going to have very large impacts on the equity markets over time. When you do look at the euro in history, you'll see that a stronger euro is almost always better for the equity markets than not. And what we're seeing now is a secular bear market that is likely to spin out of control underneath 112. So on the euro, I think things are going to get very bad. Now, in time, with market makers having tons of trouble, what we're seeing is the volatility or the premiums that are being assigned to options. The fear element, as you might want to think of it, remaining high. And that's necessary because these guys are going broke. So there has to be a higher premium in options because there's a more unpredictable outlook, and they're taking losses everywhere. So options market makers are in trouble. That's why the VIX is holding up. Other thing here is just interesting from a timing perspective. This is a tool that I like to use, which tells me basically where decisions like to be made in the markets, and they tend to happen. I don't look for a decision from the cross here, but just timing near the cross. So when you see kisses like this, we're getting close to a decision. So I drew this in here. I think we're basically within a few days of a decision in the markets. This is a chart from a few days ago, as you can see. But nonetheless, sometime in the next few days, I think we're near a decision. Another thing, even though Apple has been kind of hanging in there, it's drastically underperforming. I wasn't sure that NDX was going to be able to make a new high, but it has.
Apple's not the only one.
Yeah.
You have Amazon, and you have, of course, Facebook. You have a lot. It's mainly been Microsoft holding it up.
Yeah. And so then here's our Goldman situation again, where I just think this is keep an eye on Goldman. If Goldman Goldman could have taken a 10 or $15 billion loss on this last situation with options market making. So it could have been more. I don't know what it is. Something's wrong. Here's the Russell. Basically with a breakout from what to me is going to likely be a sort of hoodwink. So people are thinking
a terminal thrust out of a wave forward triangle.
Yeah, this looks like we're looking at a very short rally that then leads to failure of a significant kind. That would be the normal expectation. Now, I'm not going to rule out that they can't come up with some sort of a way to push this higher, but I do not believe that that's likely. I think that this 110-year channel is something to keep in mind. It's very, very important to have. I've seen one other person drawing it and they drew it wrong. You have to be accurate. It's 47.
You want to show that one more time? That 110-year
channel? Yeah, I'm going to go back there. But other things that we're dealing with that are also very strange. Cryptocurrencies now there's more cryptocurrencies than there are stocks in the United States stock market. This happened in a number of years.
Yeah.
And you're seeing things like scams like this, where the damn thing went from a $27 trillion or $270 trillion market cap. I think it was 200. I think it went to, I don't remember exactly, but it was an enormous market cap, and then immedially went to zero. Here's what happened with Avis the other day. It closed at 150, and then we're up, 200%. I think it went up higher than this. I just grabbed the screenshot while it was doing it, and what we're seeing is the implosion of market making and the blowing out of shorts on these moves. Elon Musk said Tesla hurts shorts. He's got this mission to get back at every short, whether it destabilizes the market or not, whether they're a market maker or not. He has this mission. And I think it's unbelievable that he's allowed to do this, and the SEC just doesn't even say anything. So, here's again the Avis thing. Let's go back to a channel chart because that's the highlight here.
Can we make an NFT out of that chart and sell it for 100 grand? Your 100 channel?
Well, I think that's another good market to keep.
Yeah, I know it's everywhere.
Yeah, but this is the annual chart of that I think is driving the market, and I think when we get up to hitting this area, which plus or minus 1%.
That's any minute now.
Yeah.
Peter, what a great presentation, man. So Peter wasn't bearish all the way up. He thought these new highs were happening. I think it's a good time for people to, here's the flip side of the coin. And Peter, someone asked me.
I'm still near term positive on the market.
Right.
But I think it's important.
We're getting close to an inflection point in the next month or so.
Yeah, and I think this is not close enough for government work to hit that. So we are going to have to go higher. So today it looks like we're going higher.
There might be another 100 handles in it, according to Peter.
I would say if we get another 40 handles, it's probably close enough for government work. 4,700 could be enough.
Yeah.
But I would say we should probably see 47, 20, 40, 60 before really turning it in.
I was asked in an interview the other day, Dale, how do you compare what's going on now to like pets.com and the .com era? I said, well, the difference would be like between a 2.0 earthquake and a 10 in the magnitude of rampant speculation happening right now.
I agree with you.
In everything.
Yeah.
So Peter, best place for people to follow you on Twitter at MCM_CT.
Yeah, I'm doing a lot of posts there that are not specifically about markets, but if you want to follow my market commentary, you can go to MCM_CT_markets, and you have to sign up. So if you go to the profile, the top of the profile, you can get the link to sign up and register, and then you'll get access. And that basically, I only post market related stuff there. And it's, a lot of times I'm posting, most of the moves that are happening in the market. So for example, overnight, we got certain moves the other night, and I was posting the setups before they happened. I don't get every one, but I get a lot of them. Just to be clear, I have a lot of conviction when I do things. So that doesn't mean I get stubborn, but it does mean that when I feel that risks are very high, I will push hard in the direction that I believe. But one of the reasons I created all of my emotional tools is because if you get imbalances in emotion, even if you have a large conviction about something, you can adjust your near-term trading so that, I can be swing short and I can take longs against that swing short. I don't think this next move in the market is going to be easy to ride as a long, and I don't think it's going to be easy to short either. So I think you need to have a combination of swing shorts and short-term trading. That's what I do over at MCM CT Markets. So it's MCM_CT_markets. And, my commentary on MCM_CT, which is used to be my main markets page, the public page. I feel like a lot of the policies going on in the world right now, I'm not going to talk about COVID or anything specific, are very oriented around a thing called Financial System 2.0. And so I think it's very important to keep on our radar what's happening with things like, for example, these debt service stocks and policies that are going on across the world, especially central banks moving to digital currency, et cetera. And I think a lot of government policies are engineered to go in that direction. I think all this stuff affects markets, which is why I'm focused on it. I'd prefer to have free markets. I'd prefer to be trading against other smart traders rather than other guys who can print money and blow everybody
planners,
water. Yeah. But, this is where we are. So.
All right. Well, throw this into your emotional sentiment indicator. I love your work.
But I think,
Does that
just one
swing
thing,
sentiment at all? Love?
yes, it
Put some
does.
love in there, man.
Well, I think, but while we have this chart up, I think, speaking of that, central bankers are watching this channel. And I think that you have the three major bubbles, all created by central banks, all connected by one line. I wouldn't ignore it.
Okay.
And if you, just to be clear, the 1929 market was created by the Federal Reserve. So that was specific Federal Reserve policy that started from the World War I. And then after the 1921 little depression, the Fed decided that they were going to start to create artificial liquidity, and specifically for real estate,
stock market,
and stock market.
Yeah.
And they created that bubble. Now here we're doing it the third time. I think it's unbelievably interesting that we have all three bubbles connected by one line.
All right, Peter. Nice look.
Okay.
Really appreciate you taking time out of the day. And as you guys can tell, Peter puts a lot of passion and energy and time into his work. So I want to thank you for sharing that hard work with us today.
The one other thing, the Euro chart tells you what's going to happen to the dollar. Somebody was just asking about the dollar. The dollar is going to go much, much stronger than people realize. It doesn't seem, in my opinion, that it should do that. That's the psychology says that dollar is going to go and fall through the floor, that the United States is going to lose reserve currency status. The problem is that people still need to settle up debts in dollar, and we have a huge shortage of dollars. And worse, this repo situation that's going on with the Federal Reserve creates even more shortages, because the treasuries which are being used in repo, that from repo as collateral, or being shown as good collateral, riskless collateral on balance sheets, are not leverageable. Normally, if you have treasuries, you can use them as base money.
Yeah,
they are base money, but you cannot, as a bank, issue more fractional reserve off of repo. So we're coming into a situation where credit rate of change in liquidity is going to hit a cliff.
But what's a pin? What's a pin that pops it? Is it yields? Anything pop it, or just dies? A natural death from it just not working anymore?
Well, I don't. This is an exogenous situation. I can't pin to any one thing that is going to do it. But what I do think is we just hit the wall. And if credit creation does not keep up with the speed of asset price rises, then you're going to get disconnects, and you're going to get defaults in credit. So you already see it. Zillow just dumped huge amounts of real estate at losses. And why did they go into that market? If you have 1 minute, it's an unbelievable story. They decided that they don't have to pay real estate fees to close on a property or to sell it. So if you look at that, it's about 10% they're saving. So they saw, okay, this is money in the bag. We can just buy places, renovate them, make a markup on what we renovated, and then we can not have to pay fees, so we make 10% for free. And here they are, supposedly knowing their market and taking huge losses. So what we're seeing already is the impacts of the slowdown in credit creation and liquidity tightening from repo. Repo increases in repo decrease liquidity. People don't understand that. It decreases bank liquidity, decreases fractional reserve liquidity, and this is a big problem. So what I'm seeing everywhere is rate of change problems, and I think we're going to hit a wall, and the wall just gets hit, and it could be the worst wall ever, because we're looking at that when that wall kind of gets approaching, all these market makers are not going to have access to the liquidity they need to actually service all these options. And I just want to mention one more thing. If Goldman or any one of these market makers decides they want to get out of the Tesla options market making business, they have options and derivatives contracts written out for 5-7 years. They have to find somebody to transfer that risk to. they can't get out easily. The impacts of this can be catastrophic.
Okay, buddy.
Okay.
And anyway, have a nice day. Anyway, there's a warning from a messenger, and so anyway, there are some real unprecedented times in the markets that veterans haven't seen, and appreciate you being here, bro. And thanks very much. Peter Cambell, you can find him on Twitter at MCM_CT_markets. And thanks again, Peter. Remember, don't just count your pips or your stock certificates that will eventually will become wallpaper. Count your blessings, and we'll see everyone for NFP tomorrow. And you could join the thank you, Peter. And you could join the team in 9 minutes for the morning edge. You're welcome, Monica. We'll see everyone. I'll see you guys tomorrow. Yes, MCM_CT. That's it. Adios, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.